All right, let's get right into it. Today we're taking a close look at a really interesting player in Japan's auto parts world, Eiken Kogyo. We're going to dissect their latest financial results for the fiscal year ending October 2025. So let's dive in.
So, when you hear about a company that makes parts for, regular gas-powered cars, what's the first thing that comes to mind? Probably not great things, right? I mean, material costs are going through the roof, and the whole world is shifting to electric vehicles. So you've got to ask, is this industry just struggling to hang on?
Well, Eiken Kogyo's numbers kind of throw a wrench in that whole narrative. Let's start with the top line, sales. They shot up by a really impressive 11.2% year over year. That's a solid start, for sure. But honestly, that's just the warm-up act.
Now look at this. Operating profit. That's the money they make from their core business. It didn't just grow, it exploded, up a whopping 47%. That is a massive jump, and it tells you they're not just selling more, they're running their business incredibly efficiently. And here it is, the grand finale. Net profit, the actual cash in their pocket at the end of the day, up almost 50%. So, going back to that first question we asked, struggling? Not even close. Eiken Kogyo had an absolutely phenomenal year.
Okay, so how on earth did they do that? Let's dig into the financial highlights and see what's really going on behind these numbers.
When you see it all laid out like this, it really hits home. You can see their sales went from around 7.3 billion yen up to 8.1 billion. That's great. But the real story here is the profit. Look how much faster the operating and net profit grew compared to sales. That's the textbook sign of a company that isn't just growing, it's getting smarter and more efficient.
So what was their secret sauce? I mean, we know material costs went up for everyone. The trick was, their sales volume increased so much that it actually made their factories more efficient. Think of it like this. Once the machinery is running, making 10,000 widgets is way more cost-effective per widget than making just 5,000. They basically outran the rising costs.
All right, but what were they selling so much of? Let's look at the different parts of their business to find the real engine of this growth.
Okay, one look at this chart and you get it. Eiken Kogyo is all about filters. That one division is basically the whole pie, bringing in over 7.7 billion yen. It's the absolute core of the company. Now you see that tiny little sliver for combustion equipment? It might look insignificant, but just you wait, it's got a big story to tell.
Let's break that down. The big guy, the filter division, grew by a very healthy 11.4%. And what was driving that? Strong sales to trading companies over in Asia. At the same time, the smaller combustion equipment division, it was also growing, but for a totally different reason. They were selling more burners for things like kitchen equipment.
But here, this is the number that made me do a double take. That small combustion equipment division, its operating profit grew by over 320%. That is just wild. And how'd they do it? Yeah, they sold a bit more, but the real key was they were able to raise their prices. And that flowed directly to their bottom line.
Okay, so we know they're making a lot of money, but is the company itself healthy? Is it built to last? For that, we've got to look at the balance sheet. Now, before we see the numbers, we need to talk about a really important metric, especially in Japanese finance, called the self-capital ratio. Don't let the name scare you. All it means is how much of the company is paid for with its own money versus how much is paid for with borrowed money or debt. The higher the number, the stronger and safer the company is.
And wow, just look at that. At nearly 78%, their self-capital ratio is sky high. This tells us that the company is basically a financial fortress. They own almost everything outright and have very little debt. Yeah, it dipped a tiny bit, but a number this high is just a massive sign of stability.
And it's not just that they're stable, they're actually growing their foundation. Their total assets are up almost 5%. And where did that growth come from? Straight up cash. More cash and deposits in the bank. You can't get a much clearer signal of a healthy business than that.
So, an amazing year is in the books. The big question now is, can they do it again? What does the crystal ball say for 2026? Let's check out their own forecast.
Interesting. They're definitely tamping down expectations for the next year. They see sales growing, but at a much slower pace, only about 3%. And look at the profit lines. They're actually predicting a small decrease. To me, that says they're being realistic. They know a year like they just had is tough to repeat, and maybe some challenges are on the horizon.
So, what's the game plan?
Well, first off, keep getting more efficient. High quality, low cost. That's a given. They also want to build up that combustion equipment business so it's not just a side gig, but a real second pillar. They're also smartening up their focus in filters, targeting things like heavy-duty vehicles and construction machinery. But the really big one, they're actively searching for a whole new pillar to carry them into the future.
And that really brings us right back to where we started, doesn't it? With the rise of EVs. The company knows it, you know it, I know it. The world will need fewer traditional engine filters down the line. They have built this incredibly strong, profitable, stable company. But the billion-dollar question remains. What's that next pillar going to be? What's going to drive their growth when the world goes electric?